Welcome back. And the crude oil is clearly the top story right now. The kind of impact that we've seen coming in between Israel and Iran has had the prices run up by nearly 12% in the Asian markets right now. To take the discussion forward on the probabilities that are being discussed, we are now joined by Juerg Kiener. He's Managing Director, CIO at Swiss Asia Capital. Juerg, hi, thank you so much for joining in. And what a start to the day where you are looking at crude oil prices surging, a preemptive attack, but it's more to do with what can happen from here on. Strait of Hormuz, top up in the headline here. Do you see an impact coming in there? Can we reach until that?
Yeah, I think, the geopolitical system has been under stress now for some time. A, because of the trade structure, but B, as well with the militarization in Ukraine, and certainly now for quite some time in the Middle East. And on both sides, we don't really see an end of the conflict yet.
Juerg, do you see an impact on Strait of Hormuz at all, or do you think before we get to that, the situation will ease off?
Look, I think Iran is keeping the right to retaliate on the attack they have. So I can't see that we're just going to walk away from that. So what's going to happen to the straits thereafter is everybody else's guess. But in general, if you look at shipping, you can see shipping rates going up, insurance rates going up. So trade routes are being rerouted. So we're going to have the impact economically being felt down the road.
Juerg, with where we stand right now, do you see a probability of a wider Middle East-West Asia conflict?
I think it's been going on already for some time. I think if you look at the present war structure, I mean, we had all North African countries involved since the last 20 years. We've been the last few years, basically whatever's been on the east side of the Mediterranean being involved and expanding. So I think we are far away from a resolution, and the conflict means militarization.
Juerg, just trying to get a clearer line there. You're saying that, a disruption on Strait of Hormuz is not ruled out?
The impact, it doesn't mean necessarily you have to close. The commercial people will make decisions on how trade gets done. And that impact is still got to come. People will not take risks by default. And as such, the market is reacting. It's reacting from a pricing point of view of commodities, and it's reacting from a point of view of people moving into precious metals.
Clearly. Juerg, with the way the crude oil prices have reacted, and we've seen 10, 12% of a surge, it seems to be cooling slightly right now, perhaps about a profit-taking as markets await for further developments or information coming in therein. How would you look at crude prices from here? How would you want to, how would you look at it until Monday, that is? Because we're looking at a weekend right now. Things can happen. Where would you see the prices?
So most bad things happen over weekends. So you can actually believe that we're going to get more reactions to that over the weekend. So I think I would rather be sitting tight and look at higher prices to go. And I don't think these prices are very high, but in general, most people haven't really got exposure to the commodity, the oil, or the precious metal sectors as such. So the weighting in people's portfolios is so low, the prices can still move up significantly.
What does it really mean for the Asian markets as well? Because Strait of Hormuz is from Middle East to Asia. I mean, that is the route there. How would you look at much of this Asian markets reacting to this?
I think in general, down the road, if it's going to be longer lasting, it's inflationary for everybody. And I think Asia can do a bit with inflation because we have the deflationary impact from the trade war with the United States. Whereas in the US, we have the inflationary cycle of the rebuilding of the economy. So we're going to be in big tides moves up and down of expectations, which way we're going to go over the next couple of months.
Juerg, geopolitics is one part of it. Tariffs is a second. The kind of weak economic data that we've seen coming from China, even US for that matter, has been a third point. And then we've seen rising inventories in US. There's just so much happening right now. How would you, or what are you watching going forward from here?
I think, in periods like that, people are looking to safeguard their portfolios. They start looking at safety first. In an environment where there are too many questions, and I think that's from that point of view, the flow is moving into gold. It's a safety net. It's a safety net against all the things we've been discussing. And I think in the US, the exposure to gold in portfolios is around 0.3%, which is about 10% of what used to be in normal times. So any readjustment on that could actually be moving the price there up significantly. On the energy side, I think we already have the impact of energy shortages, particularly in Europe. So prices can still go up significantly. It doesn't need much dislocation in energy to have higher prices.
Juerg, a final question from my side, and that really is if you can give us a sense on where the prices can be headed from here. We've seen $80+ off a high in 2025. We've seen prices go below 60 as well. It's been a volatile last 5 months. Would you say it's going to be equally volatile as we move ahead from here? And what is the price range that the markets could look at?
I think we had swing factors in the market, but we didn't have dislocation and geopolitical risks. Right now, we have geopolitical risks increasing in dislocation. So your price swings will become bigger, larger, faster, and that's going to rock quite a few people out of positions all the time because we are not used to volatility. We've been living in a world where interest rates were zero and there was only one way to invest. And today's environment is changing very differently. It looks more like the end of the 1970s. And that means, you need a conviction investment or you need strategic investments. And I think right now, both of that is just about being implemented by most investors.
Thank you very much for joining in to put it in Indian context and what it means for the oil marketing companies, which are impacted today. Stocks are down 3-4% across the board. We have MK Surana. He was the former CMD of HPCL. Mr. Surana, morning. This is Rima here. In 2 days, we've seen crude prices surge nearly $10 per barrel. Now, I'm sure, in your long career, you would have seen instances of such sharp spikes, especially on account of geopolitical tensions. So just to first, begin with the context, how will this impact oil marketing companies?
Good morning. And oil prices has always been up and down. If you see last many years, when it increases very, very sharply. We have seen prices going from, let's say, $80 to $128, and then again falling back to $50 also. So the current increase or hike is based on the increasing tensions in the Middle East and slightly uncertain world. And it will depend on how it trends out. Probably 3 scenarios are possible. One thing is that it doesn't escalate further. It escalates to engulfing the whole of the Middle East and Strait of Hormuz, and it cools down. One of the 3 possibilities are there, and the crude prices will guide about this. As far as the Indian market is concerned, because the prices had been kept static for quite some time by the government, and the variation was managed through increase or decrease of the excise duty, I assume that if the current prices, let's say around 75 or so, remains below that or maybe up to 80, I don't see that the Indian market fuel prices will be changed. And maybe if it increases beyond, government may think of managing it through excise duty, especially considering the forthcoming election in some of the states.
So which means that the oil marketing companies will have to take the hit on their retail fuel margins because they will not be able to pass it on. So this increase is going to hurt them. To what extent, sir, can the margins come off if you assume crude is at $75 per barrel? On the retail fuel side?
The retail fuel margins had been good for past few months. So there had been a clamor for reducing the prices, if you might have been seeing some of the narrations. So it only means that the reduction in the price will not happen in the immediate future. That's one. The margins which were beyond the normal level will reduce to some extent. And if the crude prices remains higher for longer time, then probably government may think of reducing the excise duty to reduce the trouble for the oil marketing companies. That's what I see as of now. Of course, it is difficult to forecast the government intention on that.
Mr. Surana, good morning. Thank you for joining in. What, according to you, is a comfortable range for oil marketing companies when it comes to crude oil prices? Because historically, with the fall in prices, the margins were at the auto retail margins, so 11 to 12 rupees a litre. Now they've come down to 3 to 4 rupees a litre. What is that price range that oil marketing companies feel, okay, this is a comfortable, say, $5 to $10 price range? If the crude continues to hover around that level, we are okay.
See, the below 60 to 70 is a good range for the Indian market. I will put it this way. Now the question is that in that case, oil marketing companies will have reasonable margin to make, and they will also have capacity to absorb some of the shocks. But we also need to be conscious about the integrated margin where there is LPG also, where the oil marketing companies had some losses accumulated over a period of time, and they have to recover that part. So overall, I see that $60 to $70 is a good price range for the Indian market. And if the tension doesn't escalate beyond a point, and then I think that by the fourth quarter, it should be back to that range. I don't see any structural reason to continue beyond $70, let's say in Q4 when the summer season gets over, the high driving season gets over. And with the increased supply of crude from the OPEC countries, which has been accelerated last 3 months, and if it continues further. But if the tension escalates, then we need to watch it out. It may be much higher.
All right, Mr. Surana, thank you so much for sparing time and joining us today to put things into perspective for the oil marketing companies considering the rise in crude oil prices. I was just reading a note from JP Morgan. They put out a note yesterday or earlier that worst case scenario, the crude oil prices may go up to $130 a barrel.
I thought 120 is a straight of
120 to 130,
yeah.
the worst case scenario if that plays out. But yes, of course, as Mr. Surana also said, that there is no structural reason for oil prices to stay above $70, considering the fact that there is a significant output hike coming in from OPEC as well. We'll take a short break, but just before we do that, CNBC-TV18 Access is a premium membership-based service available on CNBC-TV18.com. It offers members exclusive content, market intelligence, and expert thought leadership. The membership includes access to CNBC-TV18's flagship events, interaction with our journalists, along with curated studio tours, e-learning sessions, and masterclasses, and curated lifestyle benefits. Now, designed for an immersive and enriching experience, it empowers members with premium business intelligence and unique lifestyle benefits. The power of insight, the privilege of access, exclusivity, experiences, and influence is yours to claim. You can become a member by logging on to CNBC-TV18.com/access/plans.